started, we do need to take care of some housekeeping. Guys, carefully read the risk disclaimer. Any advice in tonight's session is of a general nature. Only your personal circumstances have not been taken into consideration. All right, guys, so carefully read. While you do, we've also got this cool little chat feature that Zoom has. So it's separate to the chat box. Feel free to join me there as well. Otherwise, ask your questions here just to make sure I don't miss them. I'll get a little alert every time. So without further ado, let's get started. What we're going to cover tonight is we're going to keep things general. Now, for today's session, we will be focusing exclusively on this first part. We'll have a look at the practical walkthrough in next week's session. We felt, be doing you guys a disservice if we tried to cram everything into, a 30-minute, 45-minute session. So we'll take our time. We'll carefully go through all the concepts. And if you have questions, guys, remember to ask. So first thing we're going to have a chat about is how trading works. Okay, so as a trader, we do need to understand what we're doing and what goes on to a degree in the background. If we could simplify it, it'd look something like this. So we've got ourselves here. This is us, the trader. And say we wish to interact with the markets. It doesn't matter which market, whether it's gold, whether it's Forex or the indice markets, doesn't matter. Okay, so whichever markets you're looking to interact with, you do need to go through a broker, especially so if you're based here in Australia. So best thing to do is find yourselves a regulated broker. That's where someone like us comes into the picture. We would act as kind of a bridge. All right, we're going to link you up to all these different markets. But what goes on in the background, we'll see. So we've connected you to all of these different markets here, Forex market, commodities, indices, etc. In the background, we've got a bunch of other players, liquidity providers. They can include financial institutions, banks. They're processing the order. We return that order back to you. Okay, so really, really brief summary. If we could simplify it as best as we can, this is how we do it. If there's any questions there, feel free to ask. Now, before we get into the real gutsy sort of stuff, I do want to talk about Admiral, obligatory. Considering you're all here, I figure this is something of potential interest. So you are dealing with a regulated broker. There is some sort of trading fund security as well. All of your funds are held locally. Of course, you get access to education and support like these sessions. And we are local here in Sydney. All right, guys. So I'll leave this guys here for you to have a read, but I think we want to get back into the trading stuff. So let's have a look. The next thing that I want to do is I'll draw a quick comparison between trading Forex CFDs, which is one product that we cover. We also offer the stock equity. So you'll get a bit of an understanding as to the differences at a very, very broad sense. And I've also thrown in this other one because, well, if you're in Australia, I'm sure you would know all about the property market and just how hot it's been getting. So something should be a market that should be quite relevant. We'll do a bit of a side-by-side now. So Forex and CFDs, all right, take a look at the graph. I do want you to focus with this one because this is the asset class we're going to look at today, Forex. Of course, stocks, if you don't know what they are, you're interacting with an exchange like the ASX or the Dow, purchasing shares and taking ownership. All right, you own a piece of the company, a piece of Apple or BHP, for example. Now, real estate, I think this one doesn't really need too much of a description. But what I want you guys to take a look at is the table in particular. I want to highlight this one here. The liquidity. Now, liquidity is usually one that will have people scratching their heads. Why? Because liquidity, it refers to something specific in this case. How quickly can we turn these assets into cash? Now, if there's any homeowners here, or if you've ever bought, sold property, you might know a house, it's not very liquid. It does take time to convert that asset into cash. Or you've got to find a buyer, go through settlement, so on, so on, so on. It could take weeks or months. Shares, much faster than property, but depending on the stock, it may take some time for you to actually convert those shares into liquid cash, liquid holdings. Now, depending on your broker, depending on which exchange you're going through, it could be a few business days. But the biggest difference here is when we look at Forex, it's a very, very liquid market, guys. All right, so Forex, CFDs as well. It does include things like gold, gold spot, West Texas oil, et cetera, But these instruments, when you trade them, and you will see in next week's demonstration, you can convert your position or liquidate your position very, very quickly. One click of a button, you're done. Now, like I said, I will demonstrate this. I'll show you how that looks like next time, next week's session. So come back and see that one. Let's move on to a brief overview of the different markets that we'll actually look at on the platform. So MT5, MetaTrader 5, that's the one that I will show you all next week. We'll cover or we'll focus more so with Forex, but keep in mind that you will have access to all of these markets, as well as many others like crypto, bond markets, ETFs, and as well the stock equities. We didn't talk too much about those ones today. That's a session for a topic for another session. But for today, we will focus more with FX. The beauty of MT5 though, if you learn how to place an order with Forex, learning the other ones, it's not too much of a chore. Right? It's quite easy to grasp the concepts once you've had a go. Okay, so we'll have a look at Forex. Keep in mind, a lot of it will translate over. Now, the Forex market, it is the biggest market in the world, and we'll get into that later. But the Forex market, what we're actually talking about here is the foreign exchange. So in other words, we're exchanging foreign currency. Now, I want to get into something that you'll see a lot of the time on the platform if you watch the finance report at the end of the news, and that has to do with the conventions in Forex. Okay, so the first one we're going to have a look at is currency pairings. Now, you might notice if you have a look on the platform, a demo, a live account, watch the news at the end, you'll see they always give currencies in pairs. Now, we can see this example, AUD USD. Of course, I do want to show you the technical names for these ones. So AUD, in this case, is what we would call the base currency. The US dollar, in other words, the one on the right-hand side of this, this slash, is the quote currency. Now, why is this significant? I will explain. For now, just try to remember this one. All right, AUD USD, Euro USD. Try to pick out which one's the base and which one's the quote, and you're off to a good start. All right, so let's have a look now. We understand the currency pairings. We know it's base and quote. That's how it's always paired. But let's have a look at the next slide, which is going to explain a bit more about the market in general. Like I said before, the foreign exchange, it is the biggest market, right? It's the biggest and also happens to be the most liquid financial market in the world. What I mean by that, each day, you've got an average daily turnover. And I'll give you the range. It's somewhere between, let's say, $2 trillion, upwards of $6 trillion. And that's US dollars as well. Now, let that sink in. That's the amount. That's 2 or 3 times what Australia's GDP is on a daily basis. All right, 5 days a week, 24 hours. Now, you will also find that when you trade FX, and this also applies to all of those other CFDs, all right, if it's gold, if it's Facebook shares, it doesn't matter. If you're trading Forex, if you're trading CFDs, you've got access to what we call a buy position. In other words, a long, and a sell. In other words, a short. You might have heard these words before, and I will explain a little bit more later. All right. So for now, just remember this one, buy long. Okay. In this case, we are looking to profit as the price goes up. Sell short, we're looking to profit as the price goes down. This is the key takeaway here. We will get back to this later on. So we understand it's a big market. it's a very liquid market, and potentially by being able to trade it long or short, we might even find more possibilities or more opportunities to participate. Okay, so we understand this, and I'm going to give you a little bit more context on how we come to that size. How do we justify having 2 or 3 Australian GDPs on a daily time base? All right, this is how. So if we have a look at all the different players in the foreign exchange, what we'll see is we've got a bit of a hodgepodge, as we'd call it, of all different size players. We'll start with the most relevant or the most relatable for us, and that's us, the retail trader. All right. Individually, we might not be as big as some of these other big players, but there's many, many of us. All right. Strength in numbers. So we can count on the retail traders. Now, probably not right now. On a normal day when we don't have this virus going around, we'd also have tourists. Okay, people traveling around the world, exchanging their currency for foreign currency. Of course, we'll move on to the middle-sized, the money remittance companies. Your Western Unions, for example, potentially even your PayPals, people, small businesses doing business internationally, exchanging currency in that manner as well. Now, what we'll come to in this section are what we'd call the whales, all right, the big players of the market. We'll start first with the multinationals. Think of your Googles, think of your Facebooks, your Toyotas, BMWs. They sell goods and services everywhere, but of course, at some point, they do need to send their money back to HQ, right? We've also got the pools of money. Now, these pools, they could be your pension fund if you're overseas, for example. In Australia, we've got our super funds, SMSFs. You've also got things like your mutual funds and your hedge funds. They're quite large players, or can be quite large players, depending on, for example, the size of the self-managed super fund. All right. Now, we've also got the banks. Of course, we can't forget about these guys. They, in a way, some of these banks actually control money supply, aka the central banks. Of course, we've got our commercial banks like CBA, NAB, Westpac, Deutsche Bank. They're sending money everywhere, all day, every day. Well, let's say 5 days a week. Now, if we add together all of these different size players and we count on how many transactions are occurring each day, what we'll find is we can justify that volume. All right, this isn't some number that's taken out of nowhere. The foreign exchange, it's the biggest market. Everyone in some way will likely interact with it at some point as well. Okay, you don't have to be one of these big guys. You could just be a tourist, for example. You could be a small business owner. All right, so you can see it's a big market. We understand there might be some opportunities for us to participate. Now, let's get a little bit deeper into the technical side of things. All right, I really love this part. Technical analysis, it's a lot of fun. It's great to learn, but we do need to start at the fundamentals, all right, the very basic level, and that is understanding how to read price, specifically a price quote. Okay, you need to know what price you're entering at and what price you're going to exit at. So let's take a look now. What you'll find similar to the pairings is we'll always have 2 prices. All right, guys, bit of homework. Next time you watch the telly, watch the news, finance report, or if you go down to your bank, take a look at their currency exchange board. You'll also see they have 2 prices. Right, this is the convention. Now, what are the prices? First of all, let's look at the price on the left. You could say it's called the bid price. In other words, this is the price that we're going to sell at. Now, remember how I said before, we can trade long, we can trade short. I hope you guys can all remember. Short, sell. I'll put it here. You'll have to excuse my messy handwriting. I'm trying to use a mouse, so it's probably not optimum. Now, the next price over, we've got the ask price. This one here is the price that we're going to buy at. Again, going back to before, this is the long price. Okay. Now, just take that away for today because we will revisit this in our next session when we're on the platform. I'll actually show you where you see these prices so you understand exactly what you're getting yourselves into. First of all, I want you guys to take a very, very close look. I'm going to remove all this jumble off for now. Look at the two prices and you'll see if I was to do this, buy minus sell would have a difference. In this case, it's about 0.0002. All right, I'll write it up here. This difference between the buy, the ask price, and the sell, the bid price, is what we call the spread. Why is this significant? Well, the spread, the difference between your buy and sell prices is, in other words, you could look at it like a brokerage fee. Okay. We can also describe it as the amount your P&L needs to overcome, your profit loss needs to overcome for you to see the profit. Okay. Now, the reason I say it's also a brokerage fee in a way is because when you trade Forex, as well as many, many other instruments with Admiral, your spread is the brokerage fee. We don't charge a commission here. Okay. When we get onto the platform, I'll actually demonstrate an Aussie pair, AUD USD. I hope that's one that all of you know. Now, this one, I'll actually show you what a spread would be when we place our trade. It's quite a bit different. And the reason why I wanted to give you that homework is because next time you go to your bank, take a look at the spread. Have a look at that. Compare it to what you'd see on your MT5 demo platform. You will be amazed. All right. So buy, sell, ask, bid. I hope that all makes sense so far. We will revisit the spread and I'll actually demonstrate how you can see the brokerage fee when we place our trade next week. Oh, look at this. We've got a little bit of a more deeper explanation. I might have got ahead of myself. Anyway, let's move on. We've covered that already. What I want to talk about now is leverage and margin. Now, these concepts, if you've done some reading online, if you've watched maybe YouTube videos, you might have come across these words. Now, I want to unravel exactly what they mean, and you'll actually see that these two concepts are highly interlinked. What do I mean by that? Let me start first with leverage. Leverage, I'm going to draw up something here. There's $1 sign, and there's now $3 signs. Okay, so what we're saying here in layman's terms is leverage is a trader's ability to control more money with less money. Okay, so we've got leverage as, well, aptly put in this picture. There's less money here. With leverage, we're controlling more money. Now, why is the margin interlinked? Well, this less money here, this is what we call margin. I'm going to put M. Can't be bothered writing the whole thing. Margin, in other words, it's almost like a security deposit made by the trader. It's held in your trading account that enables you to then participate in the market. Doesn't have to be Forex. This same concept applies across all the other instruments too. If you're trading with leverage, you're going to deal with margin. So remember that one, guys. Just for now, the brief summary version: leverage, your ability to control more money with less. Of course, we need to understand the risks as well. You can magnify profits. You can also magnify losses. We will explore this later. Now, margin, why is it linked? Because margin is the smaller amount that we need in our account to maintain, to open, participate in this position. Okay. Now, I want to give you all an example where you can actually try this one out. So let's say, for example, we're dealing with leverage. Retail leverage in Australia is now 1 to 30 for major Forex pairs, including the Aussie US. So let's say we're dealing leverage with 1 to 30. So we need $1 to control $30. Now, what if we were taking a look at placing a trade? This is purely hypothetical, guys, as well. I'm going to use some very random numbers here. Let's go with $60. Imagine we're taking now a position that's got a value of 60. We've got leverage 1 to 30. $1 controls 30. How much margin do we need in our account to control this trade? Have a think. There's a chat box there. Feel free to respond if you're feeling confident. If you're shy, I think you can also do that anonymously. But the main point here is to have a go. All right, so have a think. I'll give you the answer. All righty. So if you thought to yourself $2, you're absolutely right. Why is that? If you're not sure, because if we wanted to control $60, we're dealing with leverage of 1 to 30. So we need $1 margin to control $30. Divide 60 by 30, we get $2. Now, if you're thinking to yourself, whoa, hang on, John. I didn't start this to do mathematics. It's fine, because the system will actually do the calculations for you. In that same token, it's still important to understand the concepts, right? And at the same hand, to understand the risks. Very important, guys. But we will delve deeper into risk management. I'll actually go through risk management 101, position sizing, in next week's demo, but we will actually have deeper discussions about this in future sessions. So if you guys are keen, don't worry, we will have more. This is really to help you understand, or just to start unraveling that mystery. All right, so what we're going to discuss now is something I touched on already: technical analysis, but also fundamental analysis. Very, very interesting stuff, guys. We could literally talk for hours about this, and we actually will over the course of the next 3 months. So let's go through a breakdown and let's try and understand the differences, the key differences between these two concepts: technical analysis, fundamental analysis. In a summary, what they are: they're tools that traders and investors would use to potentially find position entries, to manage their orders, to leave their positions. Okay, it's really the analysis that helps you make your decisions. Now, why do we have two? What are they? I'll start first with fundamental analysis. Now, the fundamental analysis, we deal a lot with this when we're looking at investments. Okay, perhaps real estate, perhaps if you're looking at starting a business, perhaps you're looking at purchasing shares in a company. All right, we know how to use it, but what is it? So you're looking at things like balance sheets, the economy. Maybe you're looking at the geopolitical situation of China and America. Who knows? Okay, there's lots of different facets. In a broad stroke, we could describe this as the macroeconomics, right? The big picture. Fundamental analysis, that's it, guys. Technicals, this is the one we're going to focus on predominantly. Technical analysis has to do with looking at charts. Okay, you're looking at price, you're looking at supply and demand. Perhaps you're studying volume, market sentiment. There's lots of different facets. But what we're looking at here is the finer picture. We're looking closely. What is price action? What is the price movement? All right, so you can have a look, because when we trade, you'll actually see we do tend to use more technicals than, say, fundamentals in terms of frequency. So don't get me wrong, very important to understand and be aware of your surroundings, what's happening in the world. But when we look at charts, okay, it may take up more of our analysis as a trader versus, say, an investor. Okay, and look, you might be both. You might have a diverse portfolio. So when we look at either types of trading, investing, we've got these different types of analyses. Well, you might use them in different proportions. These percentages, it's to give you a rough guide. They're not gospel, guys. Okay, use them as you see fit as part of your strategy. But we will actually cover a bit deeper into facets of technical analysis, and as well, how we understand fundamentals. All right, how can we understand the impact of announcements, for example? For example, last week we had the FOMC announcement. Don't know if you guys caught that one. Fed Chair Powell's coming out a little bit cautious about inflation, and we definitely saw the impact on the charts. I will make a note. We'll have a look at that one next week because very, very interesting stuff. But before we get there, I want to just, I want you all to have a look at this bottom section here. Reason being, because when we trade, when we invest, it's not just the analyses or the ways we use these analyses in proportion might be different. We're actually going to be looking at different timelines, for example. Okay, perhaps as an investor, you've got long-term goggles on. All right, perhaps as a trader, well, you might be looking to trade short and mid-term, perhaps even long-term. Okay, depends on your strategy, your style and approach. Again, we'll cover more later. But we've also got a very key difference here, the use of leverage and no leverage. All right, if you've got any share traders in the room tonight, interesting to get your input, because you would have seen when you purchase shares in equity, like I said, guys, you can try that on the invest accounts as well. So if you want to see the differences, check it with no leverage. You'll actually see you need $1,000 if you're going to buy $1,000 worth of shares. Okay, that's what it means to take ownership. You're purchasing the shares, you own them outright. When you trade, you use leverage. There's no ownership involved because you're trading the contract. All right, we have leverage. We have different timelines. Again, take this with a grain of salt, guys, because look, there are some investors or potentially some investors out there who may have an aggressive strategy. You would also have some traders out there who might adopt a more cautious strategy. Okay, so you've got quite a wide range, similar styles though, depending on the way that you approach these ways of investing, trading. Again, we will discuss later, but for now, take a look here, long and short. This is probably the most important thing on this bottom half. Investing, think about it, guys. If you own the asset, when this is happening on the charts, happy days. All right, well, you're making money, good. When this is happening on the charts, not so good. Okay, your asset is losing value, whether it's property, whether it's shares in a company, or whether it's a car. I mean, a car's probably more likely, right? When we trade, all right, we can take either direction of the market. So when you conduct your analysis, you might determine, okay, market looks like it's going to be going up. So you might take what's called a long trade, a buy trade. You're going to profit as price rises. The short trade, perhaps if you do your analysis and you might adopt a negative view on an asset or a Forex pair, you might think, well, the price is going to go down for XYZ reason. And in this case, we would take the short trade. Now, there's a very interesting bit of history behind longs and shorts, specifically with CFD trading. The way it was introduced, I believe it was in the early 19th century, many, many years ago. They were introduced as a way for wealthy investors, people with large investment portfolios, to effectively hedge their positions. So what I mean by that, I'll break this down for you real good. So if you've got a stock portfolio, just take an example here, and prices are rising, that's great news. When your stock portfolio is now declining, not so good. Now, the CFD was introduced so that investors, they could potentially hedge their positions. What I mean by that is they could now open a short trade. So let me do it here, actually. They would open a short trade, and whatever losses they were suffering on this side, the investment side, would effectively be negated by the other side. Now, throughout the ages, not the ages, the decades, people have begun speculating with CFDs. Okay, there might still be people, I'm sure there would still be people out there who hedge, adopt that strategy. But nowadays, especially with the introduction of the internet, fast communications, data transfer, you've got people speculating on CFDs. Okay, they maybe the appeal of trading any time of day appeals to them. Perhaps being able to trade with leverage is something that would be beneficial, or they see as beneficial to them. Or perhaps they think that trading the CFD, it's more of a short-term investment, something to keep their minds active for whatever reason. Okay, so the way the CFD has evolved throughout time, it's really not changed the way that we approach trading them, which is ultimately with technical analysis and fundamental. All right, these concepts, they've been developed for many, many years. And I do want to give you guys a taste now, because this is something that we will get right into in the next few weeks. All right, I've got to be conscious of the time as well. So what I'm going to just draw your attention to first here is this illustration. I might actually get rid of this here. All right, so have a look at 1, 2, and 3. We've got the different types of charts. Now we will talk further about how we use these. Some people might prefer, and they might only use, say, a line chart. Perhaps some people only use a candlestick. For today, I'm going to give you a brief introduction of what a candlestick is, because these other two we will cover specifically when we talk about market structure. We'll cover this line graph. And when we look at candle patterns, we'll actually introduce some bar charts as well. For today, let's focus with number 3, the famous candlestick. Breaking it down real simple. Let me draw a candle for you all. Let me see, I'll do it here in the bottom left corner. So we've got a candle. We'll disregard the color. You might see a candle with a square body and lines that come off the ends. Now, the square body might be long, might be squishy, who cares? As long as it's got this this section in the middle, we call this the body of the candle. The lines that come off each end, we call these the wick. Can't fit that there. Let me put it up here. The wick. It's an easy way to remember it because a candle has a wick. So we've got the body of the candle, the wick. What do they tell us? I'll show you. Let's now imagine that we're looking at let's call it a green candle. All right. I know there's no color here, but let's just imagine this one was green. So a green candle is a candle where the price on this day of activity, it started at the bottom of the body. It started here. I'm going to put an O for open. Now, at some point in the day, doesn't matter if it's 5 minutes, 5 hours, 15 hours, does not matter. But at some point, the price has reached a low, the bottom of the wick. Now, likewise, it's come up and it's hit a high price at the top of the wick. Put a H for high. Now, at the end of the day or the session, whenever this candle has closed, it's closed higher. Put an arrow here. So closed at the top of the body. Now, for such a simple representation of price, we actually tell a lot about the price movement of this day. Number one, we've got our daily, let's just imagine we're talking days here. We've got our daily price range, and we've also got our daily closing range, open to close. So why is this important? Because I'm going to draw up a red candle here on the other side. Now, you might have already figured this one out. We've got the high, low, the top and bottom on the red one. If you haven't guessed already, we've got the open price here, and we have the close price at the bottom of the body. Now, this is important to know because a green candle we can actually see the dynamics of supply and demand in action. All right, let's have a look here. So the market at the start of the daily session, it's opened here at the bottom. It's opened some price low. Throughout the day, there's more people who were buyers than sellers, which has actually driven the price up. All right. So think about it. If you've been to an auction or if you've tried to buy, participate in an eBay auction, you would know if someone wants, or if there's many people who want one thing, so there's lots of demand, little supply, what happens? Well, the price goes up. How about the red candle? Apply the same line of thinking. The market has started high. Throughout the day, there were more people who were sellers than buyers, which has driven the price down. All right. Imagine if you've got the worst house on the worst street and you've got no people who want to buy your house. What are you going to do? Well, if you need to sell, you might lower your price. All right. Let's say your car, for example, no one wants to buy your car. Well, you might think, okay, perhaps the price is too high. I'm going to lower the price. All right. Little demand, excess supply. This is probably the core principle that we'll learn here today with technical analysis. It's a very big fundamental principle, a building block for a lot of the things we'll talk about later. But I do want to throw in one little bonus for you as we approach the end of this session. And that is bull and bear. I do want to show you this one now because I'm going to throw these words around: bull, bear, bullish, bearish, quite often. And if you like watching videos online or if you like reading articles, you'll come across these words for sure. The bull, the bear, in this case, bull representing the green candle, bear we call the red candle. Why? Because think about it like this, guys. If you've got an angry bull running at you, what's it going to do? It's going to come charging with its horns at the ground and it's going to strike up and try to throw you in the air. How about an angry bear? What's it going to do? It's going to stand up, bring its claws down on you. All right. Watch the video on YouTube. It's pretty cool. But have a think about that. Remember this one whenever people talk about bull bear, because it'll help you remember the direction. Is price going up? Price going down. The bull strikes up, the bear strikes down. All right. So remember this one, guys, because I will throw bull and bear around a lot in the coming weeks. I'm going to get this off for the time being. And we are now going to focus on a bit of a way forward. All right. So if you've come to this part of the session, if you're thinking, all right, this is something that I'm interested in, I do want to learn how to do it for myself, I'm going to show you the approach that we walk our clients through. All right. So first, we're going to start with our strategy. You might be a fresh-faced trader. You've never done any trading, or you might have played around with a demo. We're going to get on that demo and we're going to find a strategy that suits our personalities. Very key point, guys. You got to find a strategy that works for you. Okay. It's how do we say? It's very nuanced for your risk appetite, the way that you are as a person. For example, if you're a risk taker or a thrill seeker, maybe you'd feel bored looking at a chart and waiting for a trade over months, right? Conversely, if you're perhaps more patient and you might be a very risk averse person, or you just enjoy taking your time with things, nothing wrong with that. Slow and steady wins a race. That's the old saying. Now, at the end of the day, everyone's different. So if you find, one person's strategy is not working for you, well, that's okay. Right? That person might be different to you, and that's just the nature of humans. So strategy is number one. Let's find a strategy that works for you as a person, works with your lifestyle. Once you've found the strategy, we're going to go ahead. We're going to start playing around. We're going to start learning and really focusing on that demo. And we're going to develop this strategy. I'm going to write here one. Put it in. Do this. I'm going to put here demo. And this is the first step. The second step of our learning journey, and we'd start this pretty early as well, is understanding risk management. Super, super important, guys, because at the end of the day, we want to make sure we're trading sustainably. We're not taking unnecessarily large risks, putting our capital in danger for no reason. But the other side to the coin is we also want to be managing our money effectively. Okay. So in other words, we might be looking to maximize the profitability of our strategy. So there's two sides of this coin to risk management, money management, in other words. Now we're going to take a very early focus because we will be developing our risk management plan. Again, depending on the personality type, you might be a risk taker, you might be a risk averse person. Everyone's different. It's okay. Develop it for you. That's the most important thing. The third leg, and albeit probably the most important leg of your learning journey, believe it or not, guys, this psychology element, the psychology of a trader, understanding the psychology of the market, psychology of other traders, it is fascinating. If you find trading interesting so far, no doubt you will lose yourself in all the literature, all the learning that you can do about psychology. It is so good. But psychology, it makes up a big, big, big portion of our learning experience. Why? When you get onto a live account, the psychology element is apples for oranges to your demo trading. Think of it like this, okay? If you've got a demo trade, and you're down $1,000. Now this is demo, D for demo. You might think to yourself, well, who cares? It's a demo account, it's virtual money. So what? If you were down just 10 cents on your real account, this 10 cents is real money. This is money that you've worked for, and you're suddenly 10 cents loss. Can you imagine that the thoughts, the emotions, the feelings will be very, very different between demo and live? Okay. It is, like I said, a fascinating subject. It easily makes up the biggest portion of your trading. I'll give you these stats. Find this quite interesting. And I think a lot of new traders do. I'll put here live as well, because like I said, we really developed this on a real account. Everything is different. The different portions that this circle takes up is astounding. Strategy, have a think. A lot of people might think, well, strategy is the biggest portion of my trading. In actual fact, it's somewhere between 5 to 10%. It makes up a very, very small portion of our overall trading plan. Okay, you will actually study this in the education course that we give our clients. And again, if you come back to the future ones, we'll take a closer look into strategy, risk management, psychology. 5 to 10% only is our strategy. Now, the other, let's say 30 to 35% is our risk or money management plan. Okay, it makes up a considerable portion. Well, it's very important. We do want to make sure that we're trading sustainably. We're also seeing some sort of return potentially. All right, so this makes up quite a big portion as well. We've also got here the psychology, the biggest portion. Easily, this will make up. I've got to do some maths now, and it's really late. So let me see if I can do this. This is 40, 60 to 55%, I believe. I'm just going to rush through this one really quick because of the time. Correct me if I'm wrong. I hope I don't make a fool of myself. 55 to 60%. This is our psychology. So important. All right, believe it or not. But we will develop this further. We've got lots of sessions planned. As long as you've got an understanding now that these three elements are our crux or the pillars of our trading, you'll actually understand why we can justify this. All right. If you don't have a strategy, okay, but you've got good psychology and a good risk plan, well, you might find yourself stuck. You wouldn't know when to trade. How do I enter? How do I exit? Now, if you don't develop a good risk plan, well, say that you just be a gambler. You're taking unnecessarily large risks, really not too much different to say going down to the casino. We don't want to be doing that, guys. Okay, risk management, very, very important. Now, insecure trader is what we would be if we did not have psychology. All right. If we had the greatest strategy and the greatest risk management plan, doesn't mean anything if we don't hold our nerve, if we don't have faith, if we don't have a strong psychology when we trade. All right. Not just for yourself as well, but also understanding market psychology. But this is something we'll get into with the technical analysis side of things. So strategy, risk management, psychology, guys, take a careful note because next week we're going to be stuck on the platform. It will be 30 minutes, 35, 40 minutes, who knows, of nothing but charts and going through the platform itself, MT5. I would actually encourage all of you to give it a try between now and next Thursday. See if you can find any things that you're not sure about. Try out placing a trade on a demo, try loading some indicators on, bring your questions to next week's session. All right. I did a lot of talking this day, mainly because there was so much content to cover. But next week, it's really going to be focused on the platform. And I do want you guys to make sure that you're walking away from it feeling confident about using probably the most important thing in your trading, where you manage your positions, open them, finding positions, trades, that sort of thing. All right, so we know what's coming. We will all see in the future. I've talked a lot about it, mentioned it. We'll have further webinars, largely covering the theory side of things. We'll look at historical charts with technical analysis. We'll study volume. We'll study market structure, for example. We'll take a look at risk management and psychology principles. The kicker is we've also got a live trading session. This is very cool because if you want to see how a professional trader, this isn't myself, it's one of my colleagues, Zoltan. He's a professional day trader based over in Europe, and he will be running a 60-minute seminar, online webinar next Wednesday, the 30th at 7 p.m. So between now and next Thursday, when we speak again, have a crack at the demo. Have a talk or have a come along to the live trading session. Take your notes, bring your questions to me next time, and I'm more than happy to address them for you. Now, if you want a recording as well, we have made one. So just request it from your account manager tomorrow, and they will shoot it through, as well as any other questions that you think of, right? I do stress between now and when you're confidently trading to ask as many questions as you feel necessary. There's no such thing as a silly question this early in. All right. The only way you're going to learn, become better, become more comfortable and more confident is by asking away your doubts. All right. You've got the support here, guys. So feel free to take advantage. I do look forward to seeing you all again next Thursday. I'll actually briefly see you all if you come to the session as well, the live trading session on Wednesday. But either way, we will catch up soon. Have a great weekend. Stay safe, everyone, and take good care. Good night and bye for now.